Good morning, everyone. My name is Curtis Brandon, and I'm the Program Specialist for the Department of Veteran Affairs, Office of Small and Disadvantaged Business Utilization. Thank you for joining us today for this webinar on pricing compliance, understanding RAP rates for government contractors. A few notes before we get started. I have with me today my colleague, Mrs. Wendy Bray, and also, if you have any questions, please put those in the Q&A box. The chat function is available for everyone to network and exchange information within the network. And if you have any questions, once again, please put them in the Q&A box. This is going to be a very impactful session. So we want to make sure that we are, any questions that we are filling your questions. But if we are unable to get to your questions before this session is over, we'll make sure to provide you with an answer and send you an email with with the question that you have asked. So now let's get started. Mr. Gregory Llinas is the founder of GL Solutions. He's an SBA certified small business 8A and a Virginia SWaM Certified minority-owned small business. He specialized in management, financial, and information technology consulting firms supporting federal, state, and local governments, as well as government contracting firms in the area of accounting, financial management, program, and project planning and control. Mr. Llinas has more than 30 years of experience in federal government contracting. He has managed over half a dozen organizations at the executive level, including business development, operations management, and executive leadership. Mr. Llinas is also an active instructor at the PTAC through George Mason University, University of Mary Washington, and the University of Maryland, where he teaches classes about government contracting, DCAA, and payroll compliance. Welcome, Mr. Llinas.
Thank you, Brandon. Good morning, Wendy, and good morning to all of you participants. It's an honor for me to be part of now the Veterans Affairs as part of this class. As Brandon said, yes, I have a ton of experience. You will be provided with a booklet, I believe is in PDF, that you will all receive at some point in time. Okay, with all the information and the presentation that is going to be presented in here today. In there, you will also find information about my firm, my personal email, and my phone. Okay, so if you have any specific questions, also you can direct it to me in there. And with time permittability, I will be able to respond also to you in addition to the questions that you may set to the group. And please, I ask everybody to formulate the questions. Understand they are not stupid questions. They are just questions and it's a clarification. Any comment that you may also want to include, it will be very welcome. This presentation is designed and intended for most of the C-level positions, CEO, CFO, COO, CTO, etc., who needs to understand how winning or losing contracts can affect your RAP rates, which is, the life or death situations, financially speaking, for any firm, as we discussed in here. Okay, so in this case, everybody needs to understand, okay, and it's assuming that anybody that is in here is already managing and has the ability to quickly know and understand the RAP rates. Now, we're going to be making several assumptions and several issues, not necessarily that this is the way that it needs to be, but all of you may need to understand that we have to make certain level of assumptions, and I will be explaining then how we go specifically how to calculate the RAP rates and what do we expect everybody, so to make sure that you are not locked into any big financial burden. The agenda during the instruction is going to start by understanding the RAP rates, what is regularly included into the RAP rate, how we go about calculating or different ways to calculate. Regular questions that normally come up. Can I change my wrap rate? Can I manipulate my wrap rates? Could I have more than one wrap rate at the same time using wrap rates for effective pricing? What indirect rates and how I have now and how they will be better, okay, for me or worse if I win or lose any contract. What should I be my target rate, and what at the end we present some downfall of miscalculated wrap rate, which I have seen. And then, of course, the section for questions and answers that we are expecting all of you to have. And please follow the directions for Brandon and or Wendy in there. So, starting this process now, let's just start with the process of understanding the wrap rate. What is the definition of a wrap rate? You have it in there on the screen. Is the key to the basic pricing of labor in the federal marketplace. In the federal contracting, the wrap rate is the hourly billing rate that you will charge a client for each hour of time. It's also referred to in many other areas as the multiplier, the fully burdened rate, etc. And there are other names, the loaded rates, fully loaded rates, wrap rate with a fee, wrap rate without a fee. There are multiple variations that people has in there. Assuming that you are in the service contract area, i.e. that you are providing personnel, consider that the wrap rate is how much do you need to charge on top of your direct labor rate in order to recoup all your direct plus your indirect cost plus the fee. And that's why we then call it the wrap rate with a fee, okay, at the end. If you are...
Mr. Gray, are you moving the slides? Sorry, I ain't mean to interrupt.
I thought that we went into the agenda that I was able to control the items from my computer, but it looks like I see some people are saying that the slides are not working.
Yeah, it's still on the first page. You can at the top.
Okay, so then how about that? Okay, so that's the agenda, correct?
Yes, sir. We're good to go now. You got it.
Okay, perfect. So then here is where we are about the understanding of the wrap rates, okay? Sorry about the mishap on the technology, okay? So that is part of the items, okay, that everybody needs then to understand, okay? So what do I manage? Okay, you need to have, especially because these issues are internal conversations and internal discussions that you're gonna have with your team as you are preparing your proposal, okay, to make sure that when you are talking about the wrap rate, you are talking about your wrap rate with a fee or without a fee, how you recoup your cost, okay, and how to make sure that whatever creativity you are doing is not working against you. And I say against you because in the 30 years I've been assisting multiple different contractors, I have seen many companies that comes with, oh, I am using this very creatively to reduce my wrap rate, but what happened is that they don't realize that they are missing some costs, they are missing some items, and thereafter they win a contract and they ended up losing money. And we're going to see that later on, how to do a quick test to make sure that your wrap rate, it is already fully embedded and that you are recouping all your costs from your income statement in this case. So take a lot of these things into account, that when we also says that a lot of these items depend on your accounting system, we are not just referring to the software that you use, whether it's a QuickBooks, a Delta, a Unanet, or a Jamis, or etc. We are talking your accounting system is a set of policies, procedures in which is usually 10 to 12 items. One of those is just the software that you use to make sure that you are allocating your costs correctly, that you are distributing your costs correctly, that you have an appropriate timesheet with an with the perfect labor distributions and that you are taking into account all your cost issues in there. We are not going to be going through the details about those costs because that it might be the case for a different class in there about it. But take into account that when we are talking about your accounting system, it goes above and beyond the software that you use. Okay, and the fact that you are maybe even using some of the softwares that are specialized for government contracting does not give you a guarantee that you are doing everything correctly. And I want to make sure because people say, yes, I just got a Delta, therefore everything should be okay. No, many times those systems are not set up correctly and they get into a lot of trouble because of these issues. So moving forward into this, let's go over into what it is included now into the wrap rate. If you take a look in here, we normally start with the process, and this is assuming that we are analyzing the labor rate or the what we call the standard labor rate that is 99% accepted by most agencies in the way that is being calculated, in the way that everything is loaded, which is in a value-added basis. Okay, there might be certain variations, and we're going to go over on these variations, in the next 2 or 3 slides after this. But we normally start with the labor. Okay, that is half in there. It's usually your salary. This, you hire somebody, you either pay them by the hour or you pay them by the salary. If you are having a salary and you say, oh, this person is going to be making, let's say, $120,000 in salary, to calculate the labor hourly rate that you need to calculate is pretty simple, divided it by 2080. The 2080 is a common feature that comes over, divided the salary that the person is supposed to get in a year by the total number of hours. Where the 2080 comes from, 52 weeks, okay, divided 52 weeks at 40 hours a week, that's a total of 2080 hours. That will give you the hourly rate. Then you add your indirect cost rates, which you see, in there, indirect cost rates, that includes your fringe, your overhead, and your G&A. That will be equal to your wrap rate without a fee. And then you add on top of that your fee rate, and then you will have your wrap rate with a fee. Okay, in the revenue, in the jargons that we're looking at, your wrap rate with a fee will be equivalent to your revenue. So notice that everything that we are doing in here is just cost to derive the revenue. Remember, in the government contracting, the federal government being the largest buyer of goods and services in the world, the premises is that the government agreed to reimburse you for all your known costs, except those items that the government will not reimburse you for, and they will come over from your unallowable items. If you want to understand more about the allowability, especially if you are in a small business, go to the Federal Acquisitions Regulation, FAR 31, and that is where all the FAR items for a small business are listed in there and how you are supposed to use. Take into account also that the government is expecting you to have your accounting system be made on an accrual basis, not on a cash basis. Something very, very important because some accounting software can only work on a cash basis. Okay. So looking into this, and you see there the definitions: annual salary divided by the number of calculated hours, 2080, the fringe rate as a percentage of the basis of your fringe rate pool. Okay, so everything is a percentage of overhead, percentage of G&A, and understand that in the commercial sector, overhead sometimes is used interchangeable as G&A, not in government contracting. The main definitions to understand that is that an overhead rate or overhead costs are those costs that you need to have in order to keep your current contracts running. Therefore, if your company is formed but you do not have any contract, technically speaking, you have no overhead rate as the actual, just G&A, which the general and administrative expenses are those costs that you need to have in order to keep your company running. Therefore, whether you have contracts or not, you are always going to have some G&A rate. And the fee, of course, is how much you get as part of the percentage of the fee that is supposed to cover, number one, your unallowables and then your profit, because we are all here working for a profit. The calculations of the formula, you can see it there at the bottom, which is your direct labor times 1 plus the fringe as a percentage, times 1 plus your overhead as a percentage, times 1 plus your G&A as a percentage, that equal your rack rate without a fee. Then you add the fee, 6, 10, 12%, okay, whatever fee you may, you think that you can calculate in there, that will give you your rack rate with a fee at the end of the areas in there. So that is the main way that we will be calculating. Don't worry, all of this is going to be in the booklet that all of you are to receive or may have received already. Okay? So that's part of the items, okay, that I need everybody to take into account. So as in the continuation then in here about what is calculated in the rack rate, then let's go now to certain level as what we need to have in there. Remember that the correct definition of a direct cost is those that have only one cost objective. Any indirect cost has more than one cost objective. That's the actual technical definition. Therefore, when you are looking into this, you need to understand that yes, the fringe has more than one cost objective, which is okay to compensate the individual, not just for the different items, but there are multiple different items related into your fringe, such as pay time off, such as holidays, such as 401k, such as your also the statutory taxes that you have to pay through the payrolls. If you remember, the Social Security and Medicare cost is split at 50% the employee pays, the other 50% the employers pay it. Okay, so if you wanted to know how much a company is looking, just look how much you've been deducted in any pay stub, and that's the exact same amount that the company is also contributing to your Social Security. So it's twice the amount that you see in any pay stub. Therefore, we calculate and conglomerate, and aggregate all these costs together, okay, that represent the benefits of your company. Okay, that can include how much a company is paying for your health insurance, how much a company is paying for your 401k, how much is paying for unemployment insurance, for workers' comp insurance, or any other insurance that you see that any company offers as a benefit. And then all this cost is aggregated together and divided by the basis. The basis is the denominator that we have, and the basis of the fringe is total labor, including direct labor, overhead labor, G&A labor, or any other labor, depending on the multiple multiple and different pools that you may have into your company. Take into account if you have an intermediate pool that includes labor, you may need also to include that intermediate pool also in there as part of that rate. That is then expressed as a percentage. Notice I'm using just a plain and simple numbers to understand it. None of these are real rates, just to let you know. But let's say if your fringe rate is 25%, what's the meaning of that 25%? It means that for every dollar of labor that you pay, you are offering your employees a 25% in additional benefits. Notice that I say additional benefits on top of your rates. That is the most important issue to understand. So when you say that your French then becomes 1.25, that means that for every dollar that you pay, you will need an additional 25 cents in order to cover those benefits. Remember, we haven't touched any benefits, any profit for the company. We are still in cost in here. Then we go over to in there, the overhead. Remember, overhead costs are those costs that you need to use to have in order to keep your contracts alive. For example, if you are required to run background checks, if you need to run any recruiting costs, you may need to have, okay, all of those are part of your overhead costs. Okay, you may need to have people managing your overhead costs. That's part of your overhead labor. You need them to load them as part of the cost and the distribution in there to your overhead costs. So now, and then divide it by your basis. Now your basis include your direct labor plus the fringe associated to direct labor. Now, if you have any DMP costs or any R&D costs, then you may need to add the R&D labor and the R&D fringe rate related to that. That becomes the basis for the denominator of your rate. Is also expressed as a percentage. Notice that now the percentage are getting a little bit smaller, usually the 5%, because the basis become extraordinarily high in there. When it comes over now to your regular G&A, assuming that you have the very simple calculations of the three regular pools, French, overhead, and G&A. You take a sip of water, hold on. The French, overhead, and G&A, then your G&A, okay, all the costs, including maintaining your costs, the salaries of all the C-levels and the different individuals related to the management, plus all the business development, plus a lot of the BMP costs that you may have, okay, to run for this, and the issues, on some of those issuance costs that you have in order to keep your company alive in that case. That's your numerator, and then the denominator, or the basis as we call it, is going to be now your direct labor plus the fringe associated to direct labor that we calculated as part of the fringe, plus the overhead associated with the direct labor and the fringe. And if you do not have any of the other costs that can make your G&A to be a value added, and let's say that is now what is known as a total cost input, okay, then you are looking then that you add your ODCs, travels, etc., that are regular as part of the allowable cost. If you have any ODC costs, okay, that they will also be considered in there. Usually the fringe, which is the bottom, we normally call it a tier 7 because it goes in tiers depending on the value added that you are adding. It comes in there. That is also expressed as a percentage. And as you can see there, for example, as I am expressing how this item gets added, you see that your fringe become 25%, then the 25%, your wrap rate. Then once you start adding to the overhead, with the 5% becomes, okay, 1.44, and okay, and then you add the 10% for the G&A, it becomes 1.59 as part of the wrap rate, and that will be the wrap rate without, the 1.44, the wrap rate without the fee, and the 1.59, once you add another 10% in fee, becomes your wrap rate with a fee. Okay? So,
Mr. Greg, before you go on, I know you've given us a lot of information. It's a few questions about, the one-on-one fees and stuff. Do you mind answering them now while you're still on this page?
Sure, please, go ahead.
Okay, so one question came in is, what is the one-on-one plus fee? I'm not clear on that.
The 101 plus fee? oh, 1 plus fee is because the fee is also expressed as a percentage. Let's say if you are charging us a 10% fee, in order to calculate the rack rate correctly, you need to have 1 plus the 10%, which become the 1.1. That is part of what you see going from here, okay, to here. I'm not sure if you can see my cursor or not.
No, we're not able to see your cursor, but it's in the formulas that you're using. You use one a lot, like under calculation, DL times in parentheses 1 plus FR times the 1 plus OH. I think their question is, what is this one? Or is it always just going to be one when they're doing their calculation?
Yes, it's always going to be 1 because you have to add the 1 to your percentage.
Okay, thank you. So basically they just need to, they could just copy this formula, but always make sure that they're always including that 1 plus whatever the FR, the OH, and GA is.
That is correct. And that's why you see it in here when I put this formula that I say the calculation will be your direct labor plus 1 plus the fringe rate times 1 plus the overhead rate times 1 plus the G&A rate times 1 plus the fee rate in there.
Okay,
This is
perfect.
what is
Thank
called
you.
the value added formula, okay, for the rack rate.
Thank you. I got another question too. When figuring the percentage of the fringe, is that the percentage of the ag rate payroll per individual, and which consists of the fringe?
Take into account that when you're talking about the fringe, you're talking about a fringe pool. So you are taking all those ad rates that you are paying for different people and adding them into a consistent pool of those items. For example, okay, if some of you have run the payroll and you see that at the bottom of your ADP or your paychecks or your Gusto, whatever payroll you're doing, they tell you the total amount that the company has to pay for all the, let's say, for all the Social Security rate. The company contribution, let's say, is going to be $24,000 as an example. That's the amount that it will go in there as part of the total cost. And then to the Social Security, then you add your Medicare, that at that moment might be a couple of $1,000s. And then you add the company contribution that you are doing about your Social Security, your health care. For example, if you know the health care per person might be $1,000, but you say the company is covering 60% of the health care, then that means that you are adding every month the $600 in there as part of the health care of the cost that you are doing. The whole point in here is to make sure that the company can can recoup the cost that they are doing, whether it's a direct or an indirect cost. They want to make sure that you are recouping that cost from the government when you are bidding into any contract in there. And the same premises established, okay, because that's the concept of the pools. We put together all the common costs that are known and all the costs that are really good to understand that they should be in there. That's the most important part. Make sure that you are putting all the costs together, okay, as part of that. And second, you may need to make sure that you are consistent on how you are calculating all your pools. I have many people that says, well, I do it for this contract in this way, but for this other contract, I do it in another way. That's a big no. You need to make sure that you are consistent in calculating your pools for all your contracts into the exact same way. You may have different pools, which we're going to see in a moment in there, okay? But does not mean that you are not consistent in your calculations in that case. Does that help to clarify for these questions?
Okay. Yes, it does. Thank you.
Okay, perfect. So this is assuming that, the fringe is at 25%, overhead is 5%, G&A is at 10%, and then you want to charge a 10%, or that is your policy to charge at least a 10% fee. This can be 10, 5, 15%. The FAR regulates how much fee you can charge in there. Okay, and you can see that, just depend on the different and multiple type of contracts. If you do have a different type of a contract, for example, for cost plus contracts, the government feels that they are taking most of the risk, the financial risk of the contract. Therefore, they're going to ask you to calculate a lower fee. If you are charging a into a fixed price contract, then their company is taking most of the risk. Therefore, you are allowed to charge a higher fee to calculate that. Okay. So that is going to be the way that you determine, okay, the fee in there. And of course, it's always a negotiated basis, okay, in there. Okay, so I saw somebody asking about the salaries for GNA. You calculate it in the exact same way for the salaries of your direct labor divided by 2,080. They become part of the basis of your fringe, but they are allocated as part of the cost. Make sure that you need to have a very, very good labor distribution that is required. Some of you have already been audited by the CAA. You know that's the first thing that the CAA goes through, okay, which is, okay, your labor distribution, okay, how you are allocating and distributing the cost among the different cost objectives, whether it's direct, indirect, whether it's, to manage your company, the overhead, or the different areas within your company. Yeah. Okay. So that is part of the efforts. Okay, so now many people says, okay, can I have more than one pool? Yes, you can have more than one pool. Oh, before I forget, the BMP and labor cost. The BMP, while it is a GNA cost, okay, is used as part of the basis for the overhead, because it is assuming that in order for you to do your bidding or your R&D, you are taking resources from your people who are doing direct labor costs, and that's why it is included in there. It's never a huge significant amount, but that's the premises of what it is in there. Okay, if you ended up having, like a lot of companies have also what is called subcontractors, okay, or consultants, and you want to have a different rate for your subcontractors so as not to charge them with an overhead rate or with a GNA rate, then you may go from your basis of your GNA to be a total cost input to be a value add, which is mean that then in your GNA, the only cost that is going to be going into the basis is the cost of managing those materials and handling, and the cost of managing those subcontractors. Okay, in there, as the subcontractor rate is going to be a completely different level rate. So at that moment, you are going from total cost input to a value added. It's a little bit more complicated, but you just simply need to make sure that when you are bidding, that you are not losing any money. That is a very good, effective situation. If you are bidding into a contract that you may end up having a very large number of subcontractors in that case, in there. So what are the main considerations about the RAT rate? Okay, those are the items that we now have to take into considerations, and we've been mentioning a lot of them. Number one, you need to make sure that your accounting system allow you to make all these calculations. If you have more than just your three different pool rates, the French overhead and GNA, and you may want to have two different overhead pools. Okay, yes, that is possible. Okay, whether you want it at the value added or not, you need to make sure that your accounting system, and remember, it's not just the software that you are using, but your entire policies and procedures, that you are using to manage your policies on how these calculations and how these items are done. Very, 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 very important. Okay. So this is, what you need to make sure, because many people, for example, come over and ask me, what is the right overhead rate? And I tell them, I don't know. What do you do? It's just depending on what do you do. If you are into a regular staffing, i.e. that you are only providing people, you are expected to have a very low overhead rate because there is not that many maintenance for that. But if you are into what I call a value-added contractor, i.e. that you are providing, ways and how to operate, your overhead rate might be extremely high because you need to have the people in place to support what your direct labor people are also doing in there. I have clients that have single digits overhead rates, and then I have others that have even above 100% overhead rates. Which one is right? They are both right because these two clients are in a completely different area of operations and a different completely area of business. So you may get some information from some places that tell you, oh, this is the average overhead rate. Don't panic, because those are averages taken by, by surveying different companies, but not necessarily mean that yours are right and that yours are wrong in that case. You are the one who needs to determine how good or bad you are in terms of the type of services that you or your company is providing. For example, if you are into the regular O&M, operations and maintenance, okay, yes, everything that is known, and even the government is always looking to have the lowest cost of operation in there. That in the government contracting jargon is called LPTA, lowest price technically acceptable. Okay, and that will help you then to see and understand, okay, how much you may need to reduce your rates, okay, for that level in order to keep the operations. But at the same time that you are reducing your rate, make sure that you are not subsidizing the government. I always say that in this way, so people understand that if you are losing money because you did not do your prices correctly, you are subsidizing the federal government, because for every dollar that then you produce, you have to produce, more money in order to keep the contract alive. And trust me, many people create sometimes a strategy that I have seen since the 1990s when I started to be involved in government contracting, that says, yeah, my strategy is I will bid very low, and after I get the contract, I try to increase my prices. And I always tell them, good luck with that. Because in my 30 years of business, I have seen hundreds of people telling me of that strategy, and zero of them has been able to succeed in that case. So that is the most important part. Make sure that you do your pricing right. I have seen many companies and many people that they say we won, and I just look at the prices and I look at the rates and that they were awarded, and I just say they won't be able to perform in this contract because of the prices that I see. And lo and behold, 4, 5, 6, 7 months or a year later, you see the government canceling their contract because of the lack of performance, because they were not able to put the people to work in there. That is the main premises that you wanted to make sure that you have in there. Okay. Now, many people ask, is it possible to have more than one overhead rate? Yes. More than one fringe rate? Yes, it is possible. I have clients that have both multiple overhead rates and multiple fringe rates. Very, very common in the construction industry to have multiple fringe rate because you are using a lot of people who are on a temporary basis, okay, and may not be on a regular basis, or you're using the crew that is, for example, just, working on on the low level, that we call it the low fringe rate, because they may not get as many benefits as the fringe rate that the professional people are getting on top of your company. So I have a client that have a low fringe rate and a high fringe rate, for example. They have multiple overhead rates that, is an overhead rate for the maintenance, an overhead rate for the value added, an overhead rate, okay, if they have to provide offices to their employees because they are required, because the government might not be providing that, or if the employees are working at the government side. Okay, so they are. I used to have a client that even have 4 different overhead rates in that case. And by the way, it's always, designed together. They were audited by the CAA, and we ended up having absolutely no problem in justifying all the different rates. Now, there are multiple different intermediate rate. An intermediate rate is not considered a final rate. It's intermediate by the notion because then it gets to be distributed maybe between multiple different overhead rates and multiple different G&A rates. You have to determine as it goes in there. It may also be distributed, in between, when you are saying that I have a subcontractor rate, for example, that is considered equivalent to an overhead rate that you're using to manage your subcontractor. So you may need to have multiple different intermediate pools to distribute the cost among all those. Is it possible to have more than one G&A rate? Yes, it is. Now, that is usually reserved for large companies because they may have large type of management and administrations or different areas. Okay, it's very common for the Boeings, the Lockheed Martins, and companies like that of this world. Okay, for any small business, and I assume that everybody here is in a small business, it's not very common. But if you think that you may need to justify that, yes, we can justify that. Okay. And I forgot to flip in here. That is part of the other indirect rate pools, okay, that are normally understood, okay, and to have that. Material management pool, if you need to buy a large amount of materials, if the government is asking you to, procure a lot of this material, that's where the material management pool is going to come over, in addition to the subcontractor consulting or supporting group. That is very common if you are what is called a value-added service provider. An IT supporting pool, okay, if you have to support a very large amount of people in IT that might go above and beyond the group of your own company, okay? So that's part of facility cost, which is usually an intermediate pool, okay? That happens, let's say, if the government asks you, you need to go over and rent a very large warehouse or a large building, multiple floors, and then you need to divide it, and then you need to come out with the way to calculate how you are calculating the facilities cost, okay, and then putting it over into the different pools and different calculations that we may have in there. Okay. I am seeing the questions to be added. Brandon, anything else that we may want to clarify before we get to the next agenda in here?
Sure. We do have a couple. Do you have a template for calculating each of these pools?
We have. And if any one of you look at my emails, I will be able to forward it over to you. It's based on a regular Excel spreadsheet, okay? But understand that it's just based on the assumptions that your rates are calculated based on what I am presenting here, which is the most common methodology. I have seen companies that they have a different methodology and they say, no, for example, I have a client that for his overhead pool, he does not add the fringe to the overhead label in the pool, okay, of the cost, but in the basis again. That's fine. We did the test that we're going to show you into the next slides, okay? He recouped all his costs, so that is perfectly fine. It's a little bit confusing, and it can be very misleading to some of the evaluators when you submit to a contract cost proposal. That's why in your cost proposal, they are asking you to describe how you calculate your pools. Trust me, they are going to go over through your Excel spreadsheet calculations to make sure that you're calculating all these items correctly.
Thank you. Can you help me understand how we calculate dollars per person or contract to percentage?
Okay, repeat that again. Dollars per person?
Yeah, can you help me understand how we calculating dollars per person or contract to percentage?
Okay, well, first of all, the calculations, remember, was presented in here when you have an individual that you have the salary, whether it's a direct labor or anything, it's a salary divided by 2080. You get to an hourly rate. Okay, as you can see in here, the 2080, remember, it comes over 52 weeks that are in the year regularly times 40 hours a week. That give you the 2080. Okay, now thereafter you estimate whether this people goes into the numerator or the denominator. For example, if you are looking into a G&A person, let's say the CEO or the CFO of the company, which would be pure G&A, on their labor allocation, their cost is going to be part of the numerator of the G&A, plus fees associated with that, then that will be the cost. And the basis is going to be then all the direct labor that you may have, okay, for everybody working on all the different contracts, plus the fringe, plus the overhead, etc., then that will become part of your denominator. That's how you get that percentage in there. That's why we have this, that's what I decided, okay, to show everybody here all these formulas and where are they coming from in that basis, okay, and how they are calculated. And if you have not received the booklet yet, you will be receiving it, and all of those are going to be in there. Does that help?
Yes, thank you.
Perfect. Okay. If there are not any other questions, okay, then let's go over with the following item in which I want to show you here. This is what I call the test. Okay, so let's understand the wrap rate calculation. Let's assume that you come out and as a direct labor, you have $10,000. These are just plug-in numbers. Okay, don't try to find out where did I come out the $10,000 out of my head. Remember that we said before the fringe rate is at 25%. That means that there is a $2,500 times the $10,000 in there. You see? Then we have an overhead of 5%. It's 5% times 10,000 plus $2,500. That is $625. And then you have a G&A of 10%, which is then the sum of the 10 plus the 2,500 plus the 625 times the 10%. That give you $1,312.50. So my rack rate, which was calculated as 1.44 out of the $10,000, become a $14,000 total, $437.50 is the process of multiplying or adding all these numbers or multiplying the 1.44. Of course, there are more decimal numbers in here than you get to the 14,437.50. Then you have your 10% fee that you are expecting that give you another $1,443.75 fee. Then my rack rate with fee for 1.59 become $15,881.25. Okay. Now, this is your calculations out of that. And I am using color coding in here so you can see how this calculation will translate into the regular profit and loss or income statement that you normally will see coming from any level of accounting system. The number here at the bottom that you see here in orange becomes at the top. That's your revenue. So you are getting $15,881.25. Then your direct labor, which become then $10,000. You see it there at the top where we started. That give you profit before indirects of $5,881.25. And then you have all your different indirect costs, fringe, overhead, and G&A, which are calculated, or allocated into the exact same way. There can be no difference with the total indirect cost of $4,437.50. And then you have a profit before unallowable, which is the 15,000 minus the 10, minus the 4,430, minus the indirects, which is total 4,437.50. Give me 1,443.75. And notice that I am saying profit before unallowable cost, which is the exact same fee that you are having in there. This is what I call the test. If you are calculating your indirect rates correctly, and you know your actual indirect rates, but your income statement is not reflecting this as the aggregate of all your contracts, you may have a problem. And I have seen this a lot of, in multiple different contractors that they say, how come we did this level of calculations, we are making money, but when I go over to the regular items, then I am losing money. That is the number one questions that we are normally asked. So we need to make sure, that you are recouping, that's what I call, with the 15,881 in revenue, you are recouping not just your direct labor, but all your indirects in order to make sure that you are having a profit. Remember, once you get awarded a contract, it's very difficult to change your direct labor. The only thing that you are in control is to your indirect. You can increase or decrease your indirect, and that's why your company is going to live or die for, in that basis. Very important. Does anybody has any good questions before we move to the next slide? Indeed.
Yes, sir.
Good.
Fringe would include costs associated with the employee health benefits in the 401, etc., correct?
That's correct.
Okay. Wanted to verify, Mr. Llinas, answer the prior question about having an XLS to calculate rates. So the booklet has this in it, correct?
Repeat the last portion again, please.
Does the booklet have information on how to calculate rates, the XLS rates?
Yes, but not in the details, as I mentioned. Because remember what I said at the very beginning, that it is assumed that everybody is following and calculating already the indirect rates. And second, what I am presenting in here is the normal methodology. If your company has chosen to follow a different methodology, it may not correspond to what I am presenting in here. I want to make sure that there is this caveat. Because there is no rule on how you are to calculate your indirect rates. I have seen many companies that use many different methodologies, if you choose to do it in that way and everybody is happy, including yourself, the government cannot tell you are doing it right or wrong. They are not allowed by far to do that. It used to be in the old days, like 10 years ago, that you get audited, DCA will tell you what you are doing wrong. They are no longer allowed to tell you what you are doing wrong. They're allowed to tell you, okay, we accept it, we don't accept it. If you are doing it wrong and you agree that the CAA will accept this, that's it. You are hooked into going this until you request to change your methodology, which you can at any point in time, if you find out that you are making a mistake. So that is extraordinarily important that you need to have in there. How you are calculating this.
Awesome. Thank you. Thank you. Last one before we move on. When bidding 2,080 hours with employees working 1,912 hours, how do you calculate for the loss? How can we recoup what's paid for time off to employees?
Very good. The 900 something hours that you see is what we call the 2,080 minus the 88 hours of that you have to pay them by far regulations for the 11 holidays. It is the law of the land right now for government contractors. Whether you are a prime or a sub, no matter at what level, you have to give them the full 11 holidays, okay, minus whatever sick vacations and PTO you are providing to them. Okay, so those numbers are covered within your fringe cost that you have in there. Part of that 25% is included, in at that level. To give you an idea, about now 8 years ago, one client that I received was telling me, well, can you do a very quick review of my indirect rates? And I said, yeah, sure. He said, let me just show you what I have. And the person showed me that he was having a fringe rate of 5.5%. And I told him that is wrong. And I says, how can you know by just looking at them about the 5%? I says, because when you take into account just as part of your fringe, just your Social Security, Medicare cost is 7.65% of the total salary that the person is going to be receiving. Therefore, if he's having a fringe rate of 5%, that is absolutely wrong. That means that he's not doing his calculation right in there. So that's how I was able to determine that it was wrong. And on top of this 7.65% as part of the statutory taxes, then you need to add how much is the holidays plus the vacation. Even if you are giving them the minimum, that will take you to about 14, 15 to 16 or 17% in there. Even if you are just giving the minimums of the minimums, okay? On top of this, you still may need to give them, some health insurance because the Affordable Care Act, i.e. also known as the Obamacare Act, is still the law of the land in there, and you may need to provide certain level of benefits in there, even if it's a minimum to all the employees. So that's how you know by experience how has been, how a lot of these issues, are developed in there. But it is different for everybody. It's completely different for everybody. You cannot assume that company A will be equal to company B. It's because it's all about the management style and the management procedures and follows that you need to have. The government, when they audit you, whether it's DCAA or any other agency, the only thing that they can tell you is we like what you see. If you agree to this, this is how we're going to proceed. Period. They can also tell you, we don't like what you are doing, therefore we are not going to be doing business with you. But they cannot tell you, you need to change. They can tell you, we can or we cannot do business with you. But they cannot tell you that you need to change. I want to make sure that everybody understands those processes because there are many wrong notions about what needs to happen and what can happen or not happen, in these spaces. Does that help? Everybody understand?
Yes.
Perfect. Okay. So then we go over now to the next stage. Effective prices, that's what we are in here. Let's assume that you are tracking your indirect rates correctly. Let's also assume that your system can track everything without any problem, okay, and you are loading and allocating, and that you are managing your financial this month, that you are taking into account the two rules above, that you are tracking your indirect rates correctly, and that you are loading and reviewing your allocation of indirect rates every month. So you are in control, in the financial control of your company. If all of the above is a yes, let's start working. Let's say that you get an opportunity to place 5 people. Remember, we are in the service area with the different labor categories on the contract. So it's a matter of pricing only. Main question is how do we use the RAP rate to make an effective, good pricing? probably many of you have been in this situation many times before. Okay, so what do? Let's say in here now, I'm going to move to the next page. This is our calculation, okay? You know, we look at the current and actual indirect rates year to date, and this is what it's going to lead us, okay? So let's say that we have a fringe cost of 24,000 with a current basis of indirect rate of labor rate, okay, for your fringe, okay, your direct labor, your overhead labor, your G&A labor. So let's say my fringe right now is at 22.1%. My overhead cost is about 14,126. And the basis is my direct labor, 89. You see it in there. Okay, I'm trying to align everything together. My fringe rate to direct labor, okay, is now 19,000, which is the 89 times the 22.1%. Okay, that give me a total basis of 109 or an overhead rate of 12.06 because my overhead cost is 14,000. My G&A, my third pool, I have a cost rate of 11,782. Okay, it's always slightly bigger than my G&A labor because I have other costs like office costs, cell phone costs, etc., in addition to my labor rate plus my different fringe rate. Okay, then I loaded it with the direct labor rate. Notice that is the exact same, the fringe labor, and then the overhead, which is here the 14,126 in here. That gives me a total base of 123. My G&A rate is now 9.5%. My calculated RAP rate, which is 1.2210 times 1.1286 times 1.0950 is 1.5089, which give me a total cost of 135,752 and 50. Okay, now this my projected rates when I bid for this contract, it says I think my fringe rate is going to be at 20%. Okay, with my projected cost of $22,000, okay, and then my overhead rate 8.5%, and my G&A rate 9%. My projected RAT rate at this point in time should have been 1.4192. Then that gave me a dividend in cost of $2,330.50. Okay, for the fringe, for the overhead, and for the G&A. We added all this together, I get in excess of cost in my operations right now of $5,178.85. Okay, that is important to understand because that is what is happening, that I am losing some money because my fee that I was charging for this contract might not be enough to cover the 5,000. Now remember, we say we are getting now the opportunity to place 5 people into this contract, okay? So then we get this, calculate the net effect of your current or actual indirect rates. This is the new contract. I'm going to get to place, noticing here, $85,000, 1 people, we say 5 people, okay, multiple different level categories, 85, 75, and 3 is $60,000. We divide this by 2,080, multiply, by the number of hours. My direct labor cost now is going to go to an additional 307. So notice that now I'm recalculating my indirect rates, okay? My fringe cost, of course, is going to go up, assuming that is the same 22.1% because you are giving the same fringe benefits to all the new people. So your new direct labor is now going to be 307. Now your direct labor, your overhead, let's assume that it's going to stay the same because you might not need to make any big changes for your overhead for just having additional 5 people, and the same thing for your G&A. But now your basis goes up because now you're getting an additional, direct labor is now 397. 397, your fringe on the direct labor goes up to $87,000, 87 overhead on the direct labor. So now notice that your overhead rate went down to 2.91%. Remember, before in here, it was 12.86%. Now it's 2.91%, simply because we just increased the denominator or the basis. The same thing for your G&A rate. It went from 9.5% to 2.36%. Therefore, my new calculated WAC rate is now 1.28%, and my total cost is now 510. Now I am recouping all my benefits in there. That is the miracle of what we are trying to make sure that we have in here. Okay, is to make sure that we have the ability to recoup the cost and operate at a profit. Remember, the government really wants you to operate at a profit because they do not want you to go out of business in the middle of your contract. That is extremely important that I need everybody to understand. Nobody is, is expecting you to lose money in here. Okay? So just now everybody understand this process in here, okay, how by getting more contracts, you are reducing your RAP rates. Now you may say, what happened if I lose contracts? The opposite happened. Then your indirect rates start to go up extraordinarily high in that case. Okay? So that is the most important issue that we have in there. Any questions related to this exercise?
Yes, sir.
Somebody says in here, so your overhead and G&A polls went down due to more profit? No, due to more cost that you have. But you are also having revenue to recoup those costs. It's not profit, it's cost. Everything that we are dealing in here is cost. No, it's not suspicious if your RAP rate changes because anybody is expecting your company to grow. I have seen many times where somebody get awarded a 5-year contract, and when you were awarded, you may have just that contract alone, therefore your indirect rates were very high. Now you are operating, you may have 10 contracts, therefore your indirect rates are going to be way much lower than what you had before. And also remember, everybody, when you are into the government contracting, is subject to audit. And that's part of what we're going to be seeing in here as part of the net downfall of a miscalculated RAP rate. And I always say to everybody, if you don't like audits, get out of government contract, because you go from one audit to another to another. It's the most audited business that I have ever seen and been into. So what are the downfall? Well, first, you are locking those rates for the life of your contract. If it's a 5-year contract and you are on the fixed price or the TMN, you are locked into that contract for those 5 years. That is the main downfall. Can you operate at that level? So a miscalculation can lead to a loss that you have to make the loss then from other contracts. I had a client that, yes, they made a very, very bad mistake and they recognize it when they won. It's like, oh yeah, the good news is that we won. The bad news is that we also won. Therefore, they were losing about 10% for every dollar that they were selling to the government. They were not able to make any change to their pricing. Okay, so they have to recoup that 10% from other contracts that they had at that moment. For about 5 years, that is what it was happening. Okay.
Okay, I got a question for you, Mr. Greg.
Yes.
Back when you was talking about the G&A, would you include guaranteed payments in the G&A expense pool?
Payments from the client?
It just asks, would you include would you include guaranteed payments in the G&A expense pool?
Nope, because the payment is not, the payment, whether it's guaranteed or not, or the minimum payment is not a cost.
Okay.
Remember, we are dealing here with cost, not with payment. Any payment is a revenue. Now, if you have to make a minimum payment and guarantee to any other vendor, for example, let's say certain insurance, you have to make a minimum payment regardless of the revenue that you have. Yes, you have to include it as part of your G&A or whatever pool you may want to have, in that basis in there.
Thank you. Why on the G&A? Somebody asked, why is G&A at 10% of 10,000, which equals $13,1250?
We're talking about in here.
Yes.
12, okay. You remember the basis of the 10% is your direct labor plus your fringe rate plus your overhead times 10%. So if you add the 10 plus the 12 plus the 2,500, that's 1,250 plus the 650, then you add 1325, okay, times the 10%. That's why you get in here the 13,1250. The same thing with the overhead. It's a 5% of the labor cost plus your fringe rate.
Got it. Thank you. On the same, we're on this slide, where does the 1.44 on the wrap rate without fee come from?
Okay, if you take the 1.25, the 1, which is the 10,000 times 25%, that becomes 1.25. 1.25 times 1.05 times 1.10 equals to 1.44. You can take a calculator and do it. And that's why the amount, the 1.44 times the 10,000 becomes the 14,437.50. Remember, I say there might be some more decimal numbers here at the end that might not be shown in this presentation.
Got it. Thank you. I never seen the government use 2080s, usually 1920s. Do I still need to calculate at 2080? Is it impact on profit?
Okay, can you repeat that portion again?
Sure. I never see the government use 2080s, usually 1920. Do I still need to calculate at 2080? Is it impact on profit?
Yes, because the difference between the 2080 and the 1920 that you are seeing that the government is giving you is how much is going to be covered by your fringe rate, which is your which is part of your 88 hours of holidays, and the rest is PTO, whether it's sick or vacation that you are paying.
Awesome. Thank you. And two more for we can finish the presentation. We often have subcontractors in our bids, so would like to know how that works.
That's a very, very, very good question. When you have subcontractors, okay, if you have the three very simple pool, what happened is that the subcontractor is supposed to provide to you something like this, okay, and then you need to make sure that they are coming below the rates that you are calculating. For example, if your rate with fee is 1.59, you want to probably make sure that your rate with a fee from the subcontractor might be 1.55, because you need to have some money there to manage those subcontractors. Even if you do not have a subcontractor management rate, you still have a cost to take over their invoices, okay, and their timesheets and enter it into your system and then conglomerate it into one bill, send it in there, and when you receive the money in order to pay them to that. That has a cost. And that is a cost that you want to make sure that is included in there. Now, what is happening is that your subcontractor is actually taking costs from you, from the fringe, the overhead, and your G&A. And you are only manifesting, okay, a little bit of a percentage of your fee in that case. Now, the government doesn't like to see what is called the fee on fee. Fee on fee means that they want to make sure, yeah, you are subcontracting, but they want to make sure that you are not charging the profit fee. You can charge a management fee to your subcontractor, but the profit fee, okay, from your subcontractor, because the subcontractor is already charging you a fee. So they want to make sure that you are not having a fee on fee, and how we call it. Okay. But yes, okay, it is possible. If you ended up having a different subcontractor management rate, remember then the basis of your G&A is going to change from being very, from a total cost input to a value added, which is mean that the cost of your subcontractor rates are not going to be at the bottom of your G&A, i.e. in the basis, but just the cost of that subcontractor management rate that you have in there. Okay, I normally recommend companies and people not to go through the subcontractor handling rate or management rate unless they're going to have a very large amount of subcontractors, okay, into the contract. But if it's just one or two, it's not worth it to have it in this case.
Awesome.
Does that help?
Yes, sir. Thank you. Last question before we finish the presentation. Once again, if we don't get to your questions, we will make sure that Mr. Greg will field your questions and we will send them back out to you via email. So don't worry, we will make sure your questions are answered. With contracts awarded as LPTA, how do you calculate your wrap rates How do you calculate your wrap rates to where it is competitive and profitable? Where in the formula do you reduce the percentage, or do you do a reduction at the end of the calculation, like by 10% of the rate?
That is the $7 million question, okay, that everybody normally have. Okay. Many people operate in, number one, you need to make sure that your fringe rate is calculated correctly, your overhead and your G&A, and that you have a decent fee. I have been involved in multiple negotiations with different contracting officer, and tell you, no, we're not going to let you charge a 6% because one of them even told me nobody here, is allowed to charge while I am calculating more than 5%. Why is that? It's just completely natural, okay, and dependent in there. Now, depending on what type of a contract you have. Remember, if you have a cost plus contract, the government is taking all your financial risk because they are going to be reimbursing you for all your direct and indirect costs. But if you're having a fixed price contract, then that's when the issue comes over, and you may want to simply negotiate with them and tell them, no, we need a higher percentage fee because we are taking a risk that is much higher than normal. Now, where is your most important number to negotiate? Believe it or not, it's not in your indirect, but in your direct labor. Make sure that the numbers that you put in your direct labor are real, are feasible, and that you can execute and hire the people at that rate. I have seen many people that artificially put their too low of a cost of a number in order to win, especially on LPTA. They win, and then they cannot perform because it's impossible to hire these people at the salary level. Okay, and that's where they fail in that case. But understand the type of a risk that you are taking, understand the type of a contract that you are having, because that is what is going to be. For example, if you are into an O&M contract, you may want to make sure that you have a very low overhead. Okay, but if you are not into a very low overhead contract, then you may want to make sure that you bid and that you let the government knows, okay, how effective, okay, you're going to be. Sometimes it's better not to participate in a contract rather than to participate, win, and then have a very negative connotation. Because as I mentioned in here, as one of the consequences, okay, is that, okay, a miscalculated may lead to a huge profit. If you are up, you have price reduction that effective for certified custom pricing data, especially if you can see in your part of your contract that you are subject to the 52 to 15-10. Okay, and the second is here at the bottom. If you abandon the contract due to financial performance, it can lead you to be blacklisted on your CPARs. I assume that most of you understand what the CPARs is, okay, which is the contractor performance rate, okay, when they tell you you are good, you are bad. And the bad CPARs, which is viewed by all the contracting officers, regardless of the agencies, about how well or bad you are doing, is a big no in this case. And that's where you want to make sure that you are not in there. Okay? I have seen it also, honestly, and I have seen it a few times, that people submit a very low price, thinking that that's the way to win. And the government come back and tell you, I don't think that you can execute at these prices. And they lose because the price was too low. I also going to tell you a secret that many people sometimes have a problem to understand it. But the trick to lower your cost, your direct labor costs as much as possible, is having a very good fringe benefits. In my professional opinion, during these 30 years, the higher the fringe, the lower the salaries you're going to have. Not all the way around. Many people look at the fringe as a cost, and I can tell you, if you are looking at fringe as a cost, you are dead in the water. You have to look at the fringe as a way for you to hire your employees in the best way, shape possible. That is very, very important. Okay? So, in fact, among a lot of my clients, I can tell you that the ones that are making more money are the ones that have a higher fringe. Okay? The ones that are not making that much money have a very low fringe. I have been able to assist some of my clients hiring people and bringing from one contract to another contract, or from one company to another company at the lower salary rate than what they were making into the other company. What is the difference? The benefits that they are receiving. That is extremely important to understand. Okay? Somebody, I see here a question about the Davis-Bacon Act. Yes, the Davis-Bacon Act is extremely important portion to understand. The Davis-Bacon Act mainly tells you, the same way as the Service Contract Act, the SCA, how much you need to pay as a minimum, not as a maximum, but as a minimum to the employee based on the wage determination and based on the prevailing wages by that labor category, i.e., I use this as an example, very common in construction. Okay, you may have a carpenter in your payroll, but if he works, and we are located here in Northern Virginia, in Arlington, if he works, here in Arlington, he may have a prevailing wage that is different than if the person goes over to work in Maryland in Prince George County, because the prevailing wages might be different. All those calculations you need to take it into account when you are doing your proposal. Okay? Including the health aware benefits, the H&W, as we call it, that you are providing to everyone, and the how much you are giving for any how much you are then covering for each one of those. That's why some companies have multiple fringe pools in order to make sure that they have that. For example, you may have a fringe pool for your people who are doing work in Maryland and a different fringe pool for the people who are doing work in Virginia, because the Davis-Bacon Act, okay, have different calculations for that. Your system has to take that into account when calculating the different pools and the different items in there. Okay, which is mean that even your timesheet has to show up that you are for the same person. He works today in Virginia, tomorrow he works, or the day before yesterday he works in Maryland, and he has to conform and regulate that. Remember, under the Davis-Bacon Act, you have to provide weekly certified payrolls that also show the different level of benefits that you are providing for each one of the locations that you are doing. And all that is regulated not by the agency that you are selling, but by the Department of Labor. That one of the classes that I teach through the PTAC is about the payroll issues, and we'll discuss the Service Contract Act, and we also discuss the Davis-Bacon Act in there, because there are two very, very important things that people need to understand in there. Okay?
So, Mr. Gray.
Yes, 401k contributions are considered part of the fringe if you're talking about the contributions by the company.
Yeah.
And by the way, under the FAR 31, that's a very good point. I just remembered. Under the FAR 31, while everything is on an accrual basis, some company have the provisions. We are not going to deposit those funds until the end of the year. That's the only item under the FAR 31 that the calculation is not considered on an accrual basis, but on the cash basis, which is the contributions to your fringe pool. So they are not considered part of the fringe pool until the company lay out the cash to pay those contributions.
Mr. Greg, let me ask you a question, because this is some great information. I know it might be confusing to some, and some may need some assistance. With them needing assistance, is this something they can go to the PTAC for, the Apex Accelerator for?
Yes, the PTAC this year, they changed the name to accelerators, something, I don't remember the name because it's just brand new. When I say PTAC, it's about the accelerators force.
Yeah. Apex Accelerators.
Apex Accelerator, that's the name.
So they can't help them with their wrap rates?
Not directly. Okay, but if any one of you may need some assistance or something like that, just shoot me an email that you will have it in the booklet in there.
Okay. So we have 3 minutes left, because we'd love to give you back your time, and this has been a wonderful presentation, and we thank you. Just a few more questions. Let's see. If a construction contractor pays their DBA privileging wage directly to their employee and not paying it into a bona fide plan, do those additional costs get charged to DL or direct employee fringe cost code? What is proper?
It depends on the company policies and what is being charged. I have seen it to be charged to either direct or to the fringe benefits. Okay, there are multiple regulations. You cannot do it at both. You either charge it as a direct or you charge it to your to your fringe pool. Okay, you need to make a decision in there.
Awesome, thank you. This was a question that might have been missed. I'm not sure if we asked. I'm sorry. You still go ahead, Mr. Greg. I'm sorry.
Somebody else put in there something that I considered that it was very good. Okay. Oh, the question disappeared.
Yeah, that was in the chat. So I do have one question. I'm not sure if we addressed this earlier, but it keeps popping up. So I just wanted to know, so far we have been discussing wrap rates for direct labor. However, these calculations also apply to box sales, goods, and etc., correct? I think we answered that earlier, correct?
Yeah, that's correct. Oh, now I remember somebody talked about that a government is asking them to charge an uncontrollable shipping cost. Let me tell you, in the government, wherever you have that, my suggestion will be if somebody's asking you to have uncontrollable shipping costs, is to make sure that it's passed into what I would call it separate clean for those shipping costs. I'm just telling the government, if you want us to control the cost, then you need to let us control. If it's uncontrollable, then you may need to negotiate that claim to be at the cost plus level. Because then if it's uncontrollable, the government cannot force you to, to go into a loss.
Absolutely. Well, thank you, Mr. Greg. This has been wonderful information. We definitely have a few questions that we need to get out to you. I know you don't mind answering them. We'll send them back with this valuable information. Is there anything you want to speak about before we wrap up this presentation today?
No, that it's been a privilege. Okay, it has been great. All of you guys are asking wonderful and magnificent questions in there. Okay, yes, the last page you have in there, the booklet. Somebody's asking how they are going to get the booklet, Brandon. Okay, it is in there about, me, my company, that was part of the introductions, okay, at the very beginning, okay, and if any of you need any assistance, okay, just let me know, and we might be able to, I'm happy to assist you in that case, okay? Not sure if I can, but I just want to make sure that that's what we are in here for, okay?
Yes, absolutely. So the presentation will be sent out to everyone, and this will be recorded on our YouTube channel sometime this week. Thank everybody for attending. I hope everybody has a wonderful day. Thank you, Mr. Greg, as well, for your time and this wonderful information. We really appreciate it. We will see you guys next presentation, and thank you. Have a wonderful day. And have a good holiday of 4th of July, and everybody be safe as well.
Thank you, everybody, and have a wonderful holidays for everybody here too, okay?
Yes, thank you. Thank you, Wendy.